The Speed Coaching Series is really a unique opportunity for SMEs to connect with industry leaders in South Africa, entrepreneurs that have been there and done it all. We really think that this is an opportunity for SMEs to learn, engage, and find some key nuggets that can help them in their own growth journey.
The goal of the series is to bring together SMEs and top entrepreneurs from various industries to engage together in an interactive session of mentoring and coaching. The kind of challenges that SMEs face in South Africa is really about survival and sustainability. Many SMEs struggle to get the funding for working capital, but also funding to grow.
The other aspect is obviously access to market and being more competitive in terms of their own growth. But if we take a step back and just look at the basics, the fundamentals is how do we get companies to at least have sustainable companies in terms of their finances, their cash flows, and if you get the fundamentals right, the rest are then building blocks in terms of their growth story.
What I hope this series will aim to achieve is that in the future or a year or so, we'll see SMEs achieve that growth objective, grow their businesses to such an extent they increase the number of people they employ, and also play quite a prominent role in the economy of the country.
The Speed Coaching Series brings together industry experts and entrepreneurs that have been there and done that. And the benefit for SMEs that participate in this series is really that they, one, get to interact with these experts directly and ask them the questions that they need to know in terms of growing their own businesses. But more than that, we've focused the topics on subjects that SMEs really want to know about. Everything from how to sustainably drive cash flow, manage their finances.
The series will cover a variety of topics, what the SMEs need from the mentors. So it could go from marketing, how to actually grow your business, how to manage your business financially, looking at operational advice, but also leadership advice for those entrepreneurs who are planning to grow their businesses. We have a marketing plan in place to encourage SMEs to participate. All you have to do is to register for free, and then the session will be live streamed on YouTube. Thereafter, you'll have access to watch it.
This is an amazing opportunity for SMEs, so we encourage each and every SME in South Africa to join us. The session is free, they can register online and take full advantage of the opportunity to connect with amazing industry experts and leaders and hopefully learn a thing or two for their own business growth.
Welcome to JSE's SME Speed Coaching. My name is Sam Mokorosi. I am your host today. And today we are talking about capital raising, raising debt, raising equity for your business. I have two exciting guests and we'll be doing this segment in two sections. With me, Maurice Madiba. Maurice, welcome to the JSE. Really good to have you here. Really excited to hear your own journey around capital raising, some of the pitfalls to watch out for, some of the lessons learned in terms of when you've raised capital over time, and for your clients as well. But maybe before we jump into it, why don't you give a little bit of a background to yourself and what you do and who you are?
Sure. So my name is Maurice Madiba. Looking after Cloud Atlas Investing. We are an exchange-traded fund issuer here on the JSE. And I think for today's purposes, it may be worthwhile to share the story of how we got funded as a business. And, the products we have invest in other business, but those are very mature businesses at this stage. So, the journey of a startup is quite different to being a listed business, so it can give some insight into that.
Brilliant.
And as part of my role, what's also ended up happening is a lot of people come to us and say, I've got an idea, can you fund us? We see you guys do Africa. Are we looking to raise X amount? And, businesses at different stages. So I've also done in my personal capacity fundraising for some third parties.
Brilliant.
But pretty much, knocked on a lot of the walls that are and doors that are there.
It's important to distinguish between the walls and the doors, right?
it's a tough one.
Sometimes you knock on a wall for a while until you realize this is not a door; it's actually a wall.
So, that experience in itself
Great.
is quite enriching, and I'm hoping that for the benefit of your audience today, they'll find some value in that.
The JSE offers SMEs the opportunity to fast-track their business potential and bridge the funding gap to grow. We aim to harness the potential of our SME sector and provide insights and network building for the incubation, acceleration, and capital raising stages of private companies in South Africa. Our priority is to nurture your business prosperity.
We as a company really are very passionate about growing the economy, supporting the people of South Africa, whether it's employment creation, whether it's being more competitive, and of course attracting more investment into the country. And a big part of that is, having the new Naspers, the new Old Mutuals of the future. And that can only happen through significant support. So that was the inspiration, right? We are doing more than just the acceleration program. We're driving a lot of initiatives in terms of SME development.
Find out more about our SME initiatives at www.jse.co.za/SME.
So before we go into your stories, let's talk about your business. So you're an ETF issuer. So for those at home that might not know, an ETF issuer is somebody who puts ETFs on the exchange. So an ETF is an exchange-traded fund. And I believe your ETF is quite unique, right? You allow investors into quite a unique asset class. Why don't you just tell the folks at home a little bit about that?
Yeah, so when you look at the ETF universe domestically, a lot of investors would be familiar with top 40 trackers issued, I think, by every ETF house except us.
Right.
But an ETF generally tracks an index.
Yes.
So it gives you what we would call tracking returns, market returns.
Yes.
Versus managers actively going to look for the next set of companies.
Indeed.
So what we saw earlier in the business was that gap for rest of Africa, because the rest of Africa does have a live stock markets. A lot of countries in Kenya, Nigeria, Egypt, they have, similar to the JSE, not quite as big as the JSE, but similar to that. And so what we saw was a gap to then issue tracker that tracks those securities. It's a diversifier ultimately.
Yes.
But I think one of the interesting things is also being in those markets. I mean, being on the ground in Kenya, in Tanzania, Ghana, across the continent, and just seeing the vibrancy of entrepreneurship and business. And there's just this vast pool of potential. I almost want to call it virgin potential. That once that can mature and come to the market, I mean, it will be a wonderful thing.
So the thing I love about ETFs is that I, as Sam, can take my 100 Rand, go to my stockbroker or my bank and ask them to open a stockbroking account for me, and I can put 100 Rand into an ETF, and that ETF gives me exposure to different shares. And of course, if I wanted to track the performance of stock markets on the rest of Africa, I could just simply buy one of your ETFs. Is that correct?
That's right. I mean, it's a 1, 2, 3 process. I think point one also is registering with a broker.
Yes.
A lot of people tend to view the stock market as, my pension fund is invested there.
Yes.
But they can actually gain direct access to not only ETFs, but also stocks.
Okay.
So that whole part of financial inclusion, financial literacy, I'm also going to put it in there.
Yes.
Does also sometimes begin with just opening that account,
Brilliant.
And we need that. We've seen a lot of growth, also untapped investors there. But that's how you would start.
Yeah, so for the folks at home, if you don't have a stockbroking account, here at the JSE, we love people buying shares. And so phone up your bank and open a stockbroking account with your bank. Otherwise, go to our website, and I'm sure there's a list of stockbrokers there for you. But we're not here about investing shares. We could talk about that all day, because that's really exciting. Let's talk about fundraising as an entrepreneur. So tell us about your story starting Cloud Atlas. How old is your business, and take us through your journey of that startup fundraising.
Yeah, so Cloud Atlas has been going. I always try to remember which birthday to celebrate, but
yours or the businesses.
Yeah, because you've got one birthday when you register the business, you've got another one when you achieve a significant milestone, and then you've got another one when you inject capital into your business. So we've got various dates of the year where we celebrate those things. But ultimately started in 2013, just as a company to literally do what we were speaking about earlier, to buy and sell JSE listed shares, do some research on companies, and then keep that research within a limited liability company. So we registered it with SIPSI. Back then it was a 5-day process. I hear now it's 24 hours. You can get a company registered, so there's been growth there. And at the time I was still working. So the initial funding from Cloud Atlas was actually components of my salary going towards it, you know, getting a bank, buying 1 or 2 shares in the market, etc. That's how we started. In fact, I was working next door at Deutsche Bank, is where I started. But as time went and a bit of love grew for the markets, I was saying it's best for us to spin out of, you know, this proprietary trading, you know, trading for yourself, trading on own account, and perhaps look at creating some products that we can do in the market. Coming from an investment banking environment and background, you kind of can't, you kind of know you need to have a plan before you just make a business, you know. I spent a lot of time pitching in my former role, seeing how deals are made on the M&A transaction point of view, and thought, okay, well, this should be easy enough. I mean, let me just get my 14-page document and then go start asking people for money. That's the first place you start, if it's not your own money or family's money, or, you know, you and your friends, is you go to your SOEs, you know, or your DFIs. And just to break that down, state-owned enterprises, government, funding houses like the IDC, like the NEF. Very bureaucratic institutions, and also surprisingly very risk-averse. You know, so it's very similar to going to your bank and saying to your bank, I have a bank account and it's, you know, I'm just depositing to keep the fees going, but I need a 10 million rand loan. The bank will, firstly, won't even take your call in that respect, but they don't have that type of risk appetite. So in the initial funding of the business, I found myself just discussing the ideas with some people, and happened to be discussing with an angel investor. Somehow they were just at the table, you know, as we're having breakfast and talking, and they said, okay, why don't you come see me at the time, why don't you come see me on this day to present what you guys are looking to do? So took that meeting and said, okay, for sure, we'll do it. Because we had pitched to the DFIs already, kind of had an idea of what's required in a business plan, you know, and you can put all of those things together, your forecasts, your marketing plan, your product, your, you know, SWOT analysis.
So I always think about the fact that, you know, every no you get is a step forward, because even though they said no, you kind of know what questions are going to be asked next time, and you kind of know what documentation is going to be required. And so you're constantly fixing your pitch, making it say the right things at the right part, making sure that it answers all the questions even before. So, I mean, my advice to anybody thinking about fundraising is just get out there anyway. Even if you get the no's help you to get closer and closer to that yes.
You know, that's true, when in retrospect, because we do take it as there's two issues. One, very shy about our ideas and our business, you know. I think they talk about a place like America, where their education's probably 50th in the world, but in terms of confidence, they're ranked number one. You know, so just being able to articulate.
So we're saying South Africa's the other way around, eh?
SA is where it is. But we sometimes shy away from just talking about our business in general.
Yes, I agree.
Because we fear that criticism to say,
yes,
you know, this is never going to work.
Yes.
Or, you know, maybe you can't pull this off. And that then creates an anxiety.
Yes.
That prevents those building blocks from, you know, here's my pitch. Okay, it's missing this, this, and that. Then you incorporate it the next time.
Yes.
And that's a very important step in business, which we had the privilege of going through.
So, where does one find these angel investors over breakfast? I mean, is this some exclusive restaurants that you're having breakfast at?
Yeah.
Somebody starting out, how does one even find an angel investor?
Yeah, it's a good point, because I try to place myself in the shoes of entrepreneurs who may not move in the circles or have the networks that I was exposed to when we started out, or you know, just as a function of where you work, and who you can meet, or where you do go have lunch, etc. You know, so I always try to place myself there and see how would I navigate a situation like that, because it can be difficult, but you have to look at your surroundings and be quite intimate with where you are and who's around you. So I always say, for example, in township areas, that there's a lot of money circulating there, but tapping into it is not as easy. You know, people don't see that ability.
Yes.
So you could be living next to a ex-principal who just got their government pension fund.
Right.
You know, a few 9 million in the bank.
Right.
They don't know what to do. Maybe they're going to build a wall in their house, buy a new Benz or something.
Yes.
But they could be an investor in your business.
Brilliant. Brilliant.
Similarly with church groups, you know, there's always these different fellowship groups.
Yes.
And discussing your business there. I used to do that quite a lot at Men's Fellowship. And you would get input, and some people would say, hey, I know somebody looking for an opportunity or to invest.
Right.
So that's how you would navigate it in this day and age.
Okay. So kind of don't be shy to talk about your business.
Yeah.
Don't be shy to talk about the fact that you are fundraising. And sometimes, you know, kind of conversations lead to other conversations.
Yeah.
And I do find that, you know, when somebody is kind of taking a risk and building a business, that people can be, many people can be quite generous with their leads and their opportunities, but they'll never kind of point you to that door unless you mention, this is my business and this is what I'm looking for. Yeah.
You know, network is net worth, as they like to say.
Yes.
Even when you're in business, you still have to build a lot of relationships that you otherwise would not have to if you're just you know, doing other things. But it's that confidence factor and always being willing to go at it. I say an entrepreneur's biggest weakness or threat is when they lose that steam to keep talking about what they're passionate about and what they want to do. You know, the minute they start to silence themselves, you know, then things don't open up. Then it just seems like nothing's working, and you know, the saddest thing would be then they give up on those dreams. So yeah, having that energy to always be at it, always be vocal. One step leads to another step, you know, and one knock leads to another door, to another pathway, and then eventually you get to a place.
So maybe back to your story about Cloud Atlas. What's interesting for me is, at what stage did you resign from your day job? I mean, did you have enough money inside Cloud Atlas to cover your monthly expenses, rent, petrol as an individual? Or were you brave enough to take the step to say, my business will feed me, let me jump out now?
Yeah, good point. So this discussion of before we got, let's say, our first million into Cloud Atlas to fund us, it was probably a good 2 years, you know. of back and forth. 1 year of dealing with DFIs and
Yes.
refining the pitch. And then the second year of actually convincing yourself that it's time to move. And so the most difficult conversation was actually with family, because
Yes.
if you've got a stable job or you have an
Yes.
idea, I mean, you know, growing up, sometimes parents want you to go along a certain
Yes.
path, and now you're going to tell them I'm deviating to
Yes.
do my own business.
Yes.
Yeah, those are long conversations
Yes.
to have.
Yes.
But we spoke to our funders. They told us, I think within the year, this was now 2015, no, 2014. They call us and say, no, come present to us on Heritage Day, 24
Right.
September.
Yes.
We go, we pitch. They come back, they deliberate, they say, okay, we're going to invest, and this is how much money we're giving
Yes.
you. We were just, you know, through the moon. Yeah.
Yes.
It was a significant amount, and we were saying this was going to get us started. But between that day and the day we actually got the money, there was a few months
Yes.
in between.
Yes.
So the view was then saying, okay, do I go and sing my boss the song, you know,
Yes.
I've quit my job, I've quit my job, or do we wait until money's
money's in the
actually in?
bank.
And then it came to an important point, and, you know, I think from, it comes that point of faith and
Yes.
belief, you know.
Yes.
Because I, at that time, was saying, okay, well, everyone was also leaving the job, and I said, maybe I should submit mine.
Yes.
And there's that verse about Peter, you know, walking on water, being called out
Yes.
to walk on water. And I said, if you stay at the job and are hoping for the money to hit the bank, then you leave. And it's actually probably not going to happen. So
Right.
you need to make yourself vulnerable.
Wow.
And then just said, you know, I'm leaving at the end of this month. Told my former boss, and then stepped out of the business. Still didn't have the money in the
Yes,
bank, and I think
yes.
the funders. Then you start knowing what it's like to push
Yes.
with people to get things done.
Yes.
Then a few months later, the first investment then came in.
Brilliant.
So you know, the business. I mean, at that stage, you can't hire anybody.
Yes.
You're on a demo version for your website.
Yes.
You know, you're doing a lot of things yourself. So I found that step to be necessary, you know, to make things real and tangible. And you know, then they came on board, and I think they could also see this entrepreneur is not just all talk and a charmer boy, you know, but he actually is walking the talk, and
Great.
that's an important part of fundraising.
Okay. And did you? There's also that gap between your first cash and when the business is now ready to support itself.
Yeah.
Did you have to go through other fundraising rounds before you got to kind of cash flow positive or
Yeah,
cash flow
for sure.
break even?
You know, some businesses take off from day one.
Yes.
But statistically speaking, that's probably less than 5%
Right.
of all businesses. So what you want to do when you are doing funding is look at a multi-year strategy.
Right.
You know, and depending on whether you take off on day one or not,
Yes.
you still want to have cash in your war chest, you
Yes.
know,
Yes.
because cash is king
Yes.
in this environment. So we were fortunate to get equity funding
Yes.
up front, and it took us another 2 years to realize that, okay, our funding that we got is not going to take us to is not going to bring our ETFs to the JSE, as an
Right.
example. I mean,
Right.
your guys' fees, you know,
We'll edit that part out.
and not necessarily your fees, but I'm saying like consultant fees and all
Yes,
the
no.
total cost of listing a business.
It was a joke, but yes, I think you know, listing on the exchange.
But we sort of realized that if we want to achieve what we need to achieve,
Yes.
we need to make sure we've got enough cash to do that
Yes.
without going bankrupt, you know,
Yes.
or then having to go hand to mouth.
Yes.
So multi-year funding. So that process then took us another 2 years.
Okay.
Finding the right partner is also properly important, you
Yes.
know, because once your business, you can demonstrate a track record. So in some of the other businesses that I'm involved in, you know, track record is how many users do you get?
Yes.
You know, and even if you're starting out with 1,000, if you
Yes.
grow that to 10,000 over a year, that's
Yes.
good growth, you know. If you
Yes.
grow that to 20,000, that's phenomenal.
Yes.
The business doesn't have to be making profit. I mean, it
Yes.
can be burning through cash. And that's a sort of model that I've looked at, because if you focus on profitability on day one, you end up losing the true vision of the business and the kind of impact it can have.
Yes.
So for us to get to that point where we were good financially, it was an
Right.
additional
Right.
2 years.
Okay.
But I always say with businesses, always consider a business like Amazon. You know, Jeff Bezos started out selling books
Yes.
to everybody online with book reviews. Now he sells everyone everything.
Everything.
You
Yes,
know?
indeed.
And his business started in 1990, only became profitable in 2017.
Yeah, that was a long journey.
So if you focus on profit, you may miss the bigger picture.
Right.
So you want to make sure that you've got enough funding to weather storms like that.
Yes.
At least also can tap into your investors for that
Yes,
type of
yes.
funding. Yeah.
I suppose somebody's always going to have to fund your business. So if it's going to be customers, then you have to kind of figure out profitability as quickly as possible. But if you're saying, I'm going to focus on growth as kind of my target, like many kind of IT startups do, then I'm going to need external funding to fund me until effectively my customers can fund my business.
Yeah.
Maurice, you won't believe it, but we're out of time. It's been a fantastic conversation, and well done on your own journey. And I think it's just really interesting about how that self-belief, that ability to keep talking about your business and put yourself out there and help those connections happen.
Yeah.
Thank you so much.
Thanks. Pleasure.
But stay with us, and we will have a new guest up.
Introducing JSE Private Placements, the brand new state-of-the-art digital platform that smartly connects private companies with investors. If you're looking to raise debt, equity, or pre-IPO funding for your company, or if you're an investor on the lookout for new investment opportunities, JSE Private Placements is the perfect one-stop platform for you. Powered by next-generation global fintech leader Globacap and driven by the JSE's deep understanding of the scaling up process, JSE Private Placements is revolutionizing the fundraising and investment world. Turn your blueprint into a reality with JSE Private Placements today. Register at jseprivateplacements.co.za. T's and C's apply.
Ben Korisang, welcome, Ben.
Thank you, Sam. It's a pleasure to be here.
Really good, really good. Why don't you tell the folks at home a little bit about yourself, maybe take us through just some of your career highlights and what you've been up to over your career.
Yeah, thank you. I guess what I am today is Chief Executive Officer and founder of a company called Alt Capital Partners, which
Yes.
stands for Alternative Capital Partners.
Yes.
So we are private markets impact investors.
Great.
So our core business does convenience retail in townships and rural areas, and then we've also do infrastructure as well as private equity.
Good.
And yeah, briefly about myself, I was 25 years in corporate.
Yes.
So C-suite, so my claim to fame is that I was managing director of Old Mutual Properties, which is was one of the top 3, I suppose, property businesses in South Africa. I was MD of Stanlib, which is one of the big asset managers.
Yes.
So yeah, I've had an interesting, varied career to get me to where I am today.
No, brilliant, brilliant. Thanks for joining us, Ben. And really, you know, when we speak about fundraising in the SME space, I don't know about you, but I find sometimes it's easy to put the cart before the horse in terms of thinking about fundraising even before somebody has thought about the business. So maybe even let's talk pre-fundraising. What do you think the things that need to be in place should be before somebody can actually start thinking about fundraising?
Thanks, Sam. A very important question that because it's like, say, start with the end in mind, but
Yes.
there's certain fundamental things that need to be in place before you embark on the actual journey itself. So for myself, the fundamentals, I guess, one is have clarity around the problem that you're trying to solve.
Great, great.
Two, introspect and understand the competitive landscape.
Yes.
To say, how are you uniquely positioned, differentiated to solve that problem
Right.
better than anyone
Right,
else?
right.
And then reduce those two things into a business plan which effectively articulates the path that you need to travel to financial prosperity, if I can call it that.
No, excellent. And you know, I think sometimes when we talk about business plan, I've met many entrepreneurs who kind of shy away from that. And I always say, you know, if you can on one page say, well, what's my product and why is it special, and who am I going to sell it to? That's a business plan,
That's a
right?
business
And, and you know, can I produce my product for less than I sell it? Even if it's a services business, you know, you're gonna pay yourself as a staff member, or you're gonna pay somebody to provide that service. But can you do it for cheaper than you can sell it? Now, so let's say you've got a product. So let's say you've identified some clients, and maybe you haven't opened your doors yet, or your doors are open for a few months, a few years, but you realize, okay, I really need capital now, maybe to get me to the next level. Can we talk through kind of, at least in the equity space, and then we'll come back to debt just now, but at least in the equity space, that graph that we often see around kind of where you start and where you end up from an equity fundraising perspective?
A very good, complicated question. So let's try, as I simplify it as much as possible. I guess for me, one major tenet, if I can call it that, is no one is going to back you if you don't back yourself.
Right, right.
So the first phase, generally, then the easier people to convince that know you, know your track record, can vouch for your character,
Yes.
is what we call the triple Fs, right?
Yes.
It's family, friends, and fools in terms of the triple Fs.
Indeed.
So I'll say those are probably the most likely
Yes.
capital backers that will
Yes.
give you enough working capital for you to progress the development of your product. I'm
Great,
going to
great.
loosely call it product.
Yes.
For you to proof test your product.
Yes.
Do you have a market or not? And for you then to have the resources of actually completing a business plan, because it might involve a bit of research to find out what is the size of the market, how you
Yes.
niched, where can I source my ingredients or raw materials from, etc., etc. So the first level of that capital is primarily from those three. So let's call it
The three
phase
Fs.
one. And then phase two then is, okay, let's call it in the realm of, can I call it grant funding, enterprise development.
Right, right.
So all funding programs that, can I say, government has created
Yes.
to catalyze the growth of small and medium-sized enterprises in South Africa. And generally, all the things then that we've done, can I call it in base case, the triple F process, or the
Yes.
process that takes us there. So they're going to need your business plan, By that time, you must have a team.
Yes.
By that time, at least you must have done your thinking. And it will help if you've sold something
Right.
to develop a bit of a track record.
Yes.
So those types of funding then will be, call it phase 2.
Right.
That will give you even more working capital to sustain yourself,
Right. Right.
say, within the first 5 years. And I say 5 years because I guess empirical studies go something like this, that within the first 3 years, 95 of the businesses actually fail.
95% failure rate. Wow.
And of the 5 that survive, 95% of those fail by year 5.
Wow.
Okay? So the next line of investors in terms of venture capital, or let me call it formalized capital,
Yes.
will only focus on the survivors after 5 years.
Right. Right.
Because if you look at those investment criteria, most of the time you must have had a turnover level of about 10 million.
Right.
But they want to have comfort that you have survived the
Yes.
initial early stage of a business.
Right.
So I'll then say, yeah, so to sum up then, year 0 to year 3 as friends, as the triple Fs, 3 to 5 will be mainly grant funding.
Right.
And then from year 5 plus, then you start getting into formalized capital.
Yes.
And down the line, when you've all grown up, then you can get to the proper cash,
Yes.
being the listed capital.
Yes. So if anybody wants to list, everyone's ready for list, please give me a call. We will help you list on the JSE.
That's
But even before that, we, in that formalized capital point, maybe just to plug our new product in here, we do have JSE private placements, which allows for that pre-listing stage when you've got some revenue and now you're ready to raise capital. We allow that. So I guess in summary, then, in the equity space, there's kind of friends, family, and fools. There's grant funding. So that's quite early, and then maybe from year 5 onwards, you can start thinking about venture capital, about private equity, and then eventually a listing when you can see your share price in the newspaper every day, which is very exciting.
Yeah.
Let's talk about debt. So you know what's interesting for me, again, just speaking to entrepreneurs, is the misnomer around the cost of debt versus the cost of equity. I mean, without getting into the complexities, I do think that's something that a lot of people kind of miss between which one's more expensive, equity or debt. Do you want to maybe just quickly comment on that?
Yeah, very good question. So maybe let's deal it maybe in relation to the different type of instruments, right? So equity by nature carries a highest risk and return characteristics.
Yes.
Right? So as an entrepreneur, you must not give away equity willy-nilly.
Right.
Because it is very expensive. As in,
Yes.
you are curtailing, I suppose, your returns over the long term.
Right, right.
So in
So
accounting,
effectively, an equity partner has a share of your profits from today until forever.
until forever.
Right, right. So
Okay.
it can be expensive.
So it can be very, very expensive.
Yes.
So if equity is, say, 1, then the next class, let's call it a preference share,
Yes.
which I guess in terms of attributes, it's almost like equity, but
Yes.
it's almost like debt. So
Yes.
it's in between.
Kind of halfway there, yes.
So they call it a preference share because generally it can give you a sizable amount of, let's call it capital, with security of your business profits as opposed to your individual security.
Right.
But then it has preference over the cash flows of the business before the ordinary shareholders.
Right.
Okay?
Right.
So if shares or equity or ordinary shares are most expensive, then the next better off is then your preference share.
Right.
And then the third level of it then will be debt.
Right.
Debt, okay, so if equity, let me call it equity, is long term, preference shares are normally longer duration, but
Right.
it's structured, as in
Maybe
it's got a
medium
term
term,
to
yes,
it. Let's call
yes.
it medium.
Yes.
And then debt tends to be shorter term.
Right,
So
right.
either 3 years or 5 years or 10
Yes.
years, your debt must be paid off. So
Yes.
banks are unlikely to go above 10 years. So normally what you see is 1, 3, 5, and if you've got a good name, maybe 10.
Yes.
And then because your debt is priced on interest rates
Yes.
or prime,
Yes.
the cost of debt is more visible because
Yes.
it's defined as,
Yes.
I mean, it's got a cap to it.
Yes.
And then it tends to be cheaper, I guess,
Yes.
to get debt,
Yes.
then followed by prefs, which are
Yes.
priced a little bit higher than debt because
Yes.
they're more medium-term outlook.
Yes.
And then the most expensive then being
Yes.
equity. It's-
And I suppose the reason why it's sometimes difficult to see that equity is expensive is that there typically isn't a price put to it, unlike the debt, which
That's
says 10% interest rate per annum. You know, the equity says, give me 30% of your profits, and you don't know exactly what that's going to be over the long term.
Correct.
Okay, so debt specifically. I mean, what should entrepreneurs know and think about as they think about raising some debt for their business?
Debt is very interesting, right? So banks by nature, because of the, can I call it the responsibility that they have in our economy, tend to be conservative
Yes.
in terms of how they lend.
Right.
Um,
Right.
Which intuitively makes sense because it can't be reckless with lending because it can have a dire impact on the economy.
Yes.
So that conservativeness then translates in terms of the boxes that you have to tick as an
Yes.
entrepreneur to get
Yes.
access to debt.
Yes.
So one is your name is absolutely important
Yes.
because with a bad reputation of other previous bad credit records or
Yes.
financial mismanagement,
Yes.
it anti-selects you, right?
Yes.
It puts you in a worse off situation than someone like Sam who's got a good name. So your name is important. 2 is banks have to have clarity of cash flows.
Yes.
So I can't just go there as Ben to say, give me money, because banks want to know, what are you selling?
Yes.
At what price, at what input cost, to what profitability end.
Yes.
So, and all that, I guess, we summarize in what we call a business plan.
Yes.
Okay? As I said, I use business plan as a generic that summarizes what it is that you are about. So based on cash flows, then banks can then determine how much they can lend to you and your
Yes.
business.
Yes.
And it also determines your risk profile.
Yes.
Are you high risk? Are you medium risk? And are you low
Yes.
risk? And the importance of a risk profile or credit rating, if I can call it that, it influences the price that the banks can lend you to.
Right.
So if I've got a good name, or we always say in the context of a bigger economy, that people that have money are less risky, money is cheaper for them.
Yes.
And if I'm an unknown, money is more expensive.
Yes.
So that philosophy also then holds true to, I guess, the quality of your credit rating,
Yes.
which is informed by your business plan.
Yes. Yeah. Yeah.
And that also then, okay, so it influences how much you get, the quantum.
Yes.
Firstly, it influences at what rate, secondly.
Yes.
And then thirdly, it also influences how much security the bank will
Yes.
need and want
Yes.
to secure its lending to you.
Yes. I want to get back to security just now, but one interesting point that I think is worth bearing in mind is that if you're a solopreneur starting out your own kind of one-man show as a business, one can always fund those early days in the business using your own kind of personal credit. So whether it's swiping your personal credit card or your overdraft, that is available. Of course, as soon as possible, you want to start separating your business expenses from your personal expenses. And so, if you're going to use those means, which I think a lot of entrepreneurs do, to be honest, it's important to swap those out as quickly as possible from a personal loan, from a personal overdraft, from a personal credit card into some business financing, because I think it is important to keep those separate and clear, your personal finances versus your business finances. You spoke about security, and I think this is what sometimes trips up a lot of entrepreneurs. Maybe somebody's raising a lot of capital, but the bank says you don't have enough security to put against that loan. Can you just unpack that a little bit better and how one can potentially fix that kind of a problem?
Okay, no, great question. Can I just maybe comment on your previous comment before I do? Because it's something that personally I only learned in my now journey. So let's call it free structuring, sharing as opposed to advice. So to your point, from day naught, actually, you should separate your
100%,
personal affairs
100%.
to your business
100%.
affairs, okay? And that just has to do with, I guess, how the financial system looks at the different legal entities. And for your own personal discipline, it's important.
Indeed.
And one free advice, though, it could be, if I'm a sole proprietor, I can still take my savings into the business, not necessarily only as equity, but then as a loan.
Indeed,
Okay?
indeed. So
then
you can
if
loan
I-
yourself
you
your
can
money to your own business.
money to your own business.
Yes,
Because remember, we're separating the entities.
100%.
So you're loaning your own business
yes.
money. And the beauty of doing that is saying down the line, when other partners come in,
Yes,
because your debt will carry preference in terms
Yes.
of repayment
yes.
before it gets to the equity.
Yes, and maybe this is worth pointing out here as well, that any fundraising requires strong bookkeeping. So whether it's the bank, whether it's a venture capitalist, whether it's even a government grant, they're all going to want to see good bookkeeping.
100%.
So good bookkeeping is one of those things that you need as a prerequisite to even starting your fundraising process.
No, 100%.
Yes. We were going to talk about security.
So in terms of security, so let's take it through levels again. So as an individual, I guess our parents always teach us to say we must save to buy a home.
Yes.
So I'll say our houses then, if you've got title to it, it's a very good form of security.
Yes.
Why? Because it's a immovable asset and hopefully over time it appreciates. So I'll say your home carries far higher security. And then the next level of security will be your, can I call them movable assets? Because yes, your car is can be regarded as security. Your other shares like your unit trust,
Yes.
any other assets that's movable
Yes.
is also a form of security.
Yes.
But as a sole proprietor, the banks will definitely consider a house, I mean, before they
Yes.
consider your car,
Yes.
before they consider your clothes, because it's not really an asset, but,
Yes.
but it is an asset.
Yes.
So the harder and tangible, I guess, your asset base is for
Yes.
security,
Yes.
then the better it is for the banks to
Yes.
lend you money.
Yes. Now that's a great point. And I suppose one challenge that entrepreneurs often will find is that maybe I need this much money, but my base of security is only this small, and so maybe the bank will will only lend me a much smaller amount. I suppose maybe that's sometimes a good indication that what you might need, because your security doesn't cover your loan and the bank is saying, I need security for the loan, maybe at that stage that's a good place to be thinking about equity and grants. Because if your security can't cover the loan, maybe the bank's actually saying to you, maybe this is too risky for debt funding at this stage.
Yeah, no, 100%. So the way, I suppose, the financial system works is, let's say, to get 100% debt funding, as in it's 100% of all that you need, then it's definitely your name, reputation, track records, your balance sheet, and security that will allow them to make that type of decision.
Yes.
Okay?
Yes.
But normally, okay, let's take a bond. So a bank will say, as opposed to 100%, I'll give you 80% of the money.
Yes.
And your contribution to it is what we call equity, right?
Yes.
So you must contribute 20%.
Yes.
So then when we talk then about early stage funding, so the triple Fs,
Yes.
the grant funding, is that accumulation of those can be then used to provide the equity
100%.
and the money that you're trying to lend.
Brilliant.
And the more risky you are, the more equity a bank is going to demand.
Yes.
So to get $100, I might say they'll give you 40 and you must put in 60.
Yes.
The more credit worthy you are, they'll put in 80.
You must put in 20.
20. And even better, they'll give you 100% and you put in 0.
Yes.
And the difference then in terms of how much is how you conduct your own financial affairs that you can be able to demonstrate.
That's been great. Ben, we're actually out of time. It's been such a fun conversation. 30 minutes does go very quickly.
It does.
I have been Sam Mokorosi, and this has been Capital Raising with the JSE SME Speed Coaching Session. Hope to see you again soon, and thank you for tuning in.